Hello there. Good afternoon. Can you believe it? We are getting the jobs report and appreciation data still really strong. Welcome to another edition of SRT Live. I am your host, Sean Richard, with the Sean Richard Mortgage team here at Guaranteed Rate. Thanks so much for joining me today. And we've got a lot to unpack today. There's lots of information that we need to go over. Economic data abounds last week and this week. And so let's dive right in. Actually, but before we do, let me stop and say I hope all of you had you got to spend some time with friends, family over the weekend. You took some time out to remember those who serve and who have served on this Memorial Day, this past Memorial Day. And so our thoughts and the hearts, remembrance of those who have made the ultimate sacrifice. And so hopefully you had some good food, some good times, and some friends and family around. But at the same time, that you spent some time kind of reflecting on the reason that Memorial Day exists. So without further ado, let's dive into our information for the week. All right, so let's look back real quick at last week and some of the important economic data that came out. So as always, on Thursdays, we get the jobless claims, which is people filing for unemployment. So there's initial, which is people filing for the first time, and there's continuing claims, which are people renewing their unemployment benefits. And so we've seen a little bit of a tick up from our post-pandemic lows. So we had 210,000 new claims for last week. For the week prior, and then the previous reading was 218. So down a little bit, but we're still up. We dipped down to the 180,000, 190,000 for a little bit, and so we are starting to tick back up a little bit. It's going to be something that's really important to watch as we move forward. Because one of the characteristics of a recession, or one of the indicators of a recession, is that unemployment bottoms out. So we're starting to see a little bit of a move up, but not unfamiliar territory. So let's keep an eye on that. Continuing claims also ticked up a little bit from the previous reading. Previous reading was 1.315 million. Our reading last week was 1.346 million, so about 30,000 increase in continuing claims. We also got another GDP reading, came in at negative 1.5%. And you've heard me say this before, but the technical definition of a recession is 2 consecutive quarters of negative GDP. And so we had a negative 1.5 compared to an expected negative 1.3%. So it was a little bit worse than the market consensus. So if we end up with a negative Q2 GDP reading, we could already be in a recession and not even realize it. And a lot of times that's how recessions work. A lot of times we look back like, oh, we were in a recession. And we know that because of the lagging indicators such as GDP, negative GDP. We also got pending home sales. And I'm going to talk a little bit more about this here in a minute. But pending home sales was previously down 1.6% month over month. This month's reading, it was actually down 3.9%. And again, I'm going to harp on this until I'm blue in the face, but we cannot sell what we don't have. Inventory has been low. Now, there's been a slight increase to inventory here lately, and we'll dive into that here in a minute. But inventory in general has still been low. Hard to sell what we don't have. So pending home sales down 3.9% month over month. And then last week, we got the Fed's favorite measure of inflation, which is PCE, Personal Consumption Expenditure. And we actually saw a decrease from expected. So the market consensus was a 0.8% month over month reading, and we got a 0.2% month over month reading. So quite a bit of a decline in inflation with the PCE report. Now, year over year went down a little bit because of that decreased reading, went from 6.6 was the expectation, dipped down to 6.3% year over year inflation. Now, remember, the PCE report, it's the Fed's favorite measure of inflation, but it does not take into consideration housing costs, housing or rents. And we've been seeing significant increase in those costs. So it's not always the best indicator of inflation, since the number one expense in most people's households is that rent or that house payment. So looks like inflation may be stabilizing, but I think go back and watch the last couple of weeks, and you see that I think that we could be in for a head fake there. All right, so let's talk about today. So obviously yesterday, Memorial Day, markets were closed. Today, we got two important home appreciation indexes. We got the Case-Shiller Home Price Index, which showed that year over year, we were at 21.2% appreciation rate. Now this is opposed to last month's number, where year over year we were at 20.3. So home price appreciation still appears to be raging strong. And so all of those who maybe thought we were in a bubble 12 months ago, like, oh, it's going to pop any minute, we are still going strong. Inflation, home price appreciation is still running really strong, and that's going to be due to that low inventory, as well as inflation. With inflation being high, it pushes fixed price assets up, which home prices are that. And then we also got the FHFA Home Price Index, which is the Federal Housing Finance Agency. We got month over month numbers and year over year. Month over month was down a little bit from previous readings, where it increased 1.5% month over month appreciation. And then that's compared to last month's reading of 1.9% appreciation in homes. So a slight decline in home price appreciation, but if we extrapolate 1.5% out over an annual basis, that's still 18%. And we did see that FHFA has us at 18.7% year over year home price appreciation. So although down from where FHFA has had us in the past, still extremely strong appreciation levels in housing. So if you're looking to buy a home, if you're a real estate agent talking to your clients on whether it's still a good time to buy a home, although home prices are up, we're still seeing extremely strong appreciation. And then we also had some comments from the National Association of Realtors stating that the expected home appreciation should cool by end of this year, going into next year, to roughly about 5%. But when you own or you're buying a $500,000 home, $400,000 home, $800,000 home, a 5% appreciation rate is an extremely great place to be. That's still, $25,000, $30,000, $45,000, $50,000 year over year appreciation. So cooling down to the mid single digits in appreciation is still a really solid level of appreciation. So that's what we got today. So great home appreciation data. Looking ahead to the rest of this week, on Thursday, as always, we get jobless claims. So we want to keep an eye on that. As I mentioned earlier, one of the indicators of a recession is unemployment ticking up a little bit. So have we bottomed out on unemployment? We'll have to keep an eye on those jobless claims. And then also on Thursday, we get the ADP payroll report. Now this normally comes out on Wednesdays, on a Wednesday, but since the holiday was on Monday, it's coming out this Thursday. And this is a precursor to Friday's National Jobs Report from the Board of Labor and Statistics. And then Friday, we also get the unemployment rate, which is expected to tick down from 3.6% to 3.5%. So we'll keep an eye on that. Now, as always, what do we want to keep an eye on going forward? What is it that we need to watch out for? So number one is going to be home price appreciation over the summer months. Appreciation is still fantastic. You just heard me saying that Case-Shiller has us at 21.2%. Even FHFA, which is always going to come in, always seems to come in a little bit lower than Case-Shiller, has us at 18.7% year over year appreciation. But we want to watch where appreciation goes over the course of the summer months. As inflation starts to decline, we could see appreciation start to decline as well, which is really a good thing. We cannot sustain these double-digit levels for an extended period of time, we do want appreciation to come down. However, here's the key. Appreciation at lower levels is not the same as depreciation. We're not expecting home prices to decline. We're simply expecting them to not appreciate as quickly. So that way, home buyers that are buying right now can still expect a solid return on their investment on an ongoing basis. So big difference there. Slowing appreciation, very different than a decline in home prices. So we want to watch what appreciation rates do with the Case-Shiller report, the FHFA home index report on over the course of the summer months to see where that leads. Secondly, I want to talk about oil prices. We've had oil prices surge here in the recent days, and a lot of that has to do with the reopening of Shanghai. With opening of Shanghai, it's a lot more energy that's going to be used in the region, and that's putting a strain on global energy prices. So oil has been skyrocketing over the last 4 days. I think we're up to somewhere around $118 a barrel. Now, some of you who watch the news might point out, oh, well, oil futures are showing lower. Does this mean that oil prices will be going down in the future? And oil futures are very much a misleading data point, because oil futures have more to do with the storage of oil. So what happens is these entities, these companies that provide storage of oil are offering discounts to store the oil because it's anticipated that oil is going to go higher. So if I'm an oil storage facility and I want to be able to make more money, increase my revenue, I'm going to offer discounts for oil storage, so that way I can hold more oil, I can get more of that oil and then have it to be able to sell at a higher price down the road. So it's actually the opposite. Oil futures coming down indicate that the market likely feels that oil prices are going higher. And so that is referred to as backwardation, as odd as that sounds. So oil prices going higher in the interim, and it looks like oil prices could continue to rise with the reopening of Shanghai, with that energy usage climbing. So now might be the perfect time to go buy that Tesla or buy that electric vehicle. All right. Well, that is all the time that I've got for today. I really appreciate you joining me on this episode of SRT Live with your weekly update. Remember, if you have any mortgage questions or economic questions, don't hesitate to reach out to my team and I. Got my contact information right below here. And you're always welcome to leave comments down below, and I'm happy to answer those for you as well. And have an incredible rest of your day and your week, and I'll catch you next week on SRT Live with another market update. Thanks so much, and take care.